A sigh of relief echoing across the country today as the Bank of Canada has lowered the country's key interest rate for a second time this year.
Our Ottawa correspondent Glen McGregor joining us now from the nation's capital. Glen, there seems to be some optimism coming from banking officials.
Yeah, analysts were really expecting the Bank of Canada to announce a cut of 25 basis points. That's a quarter of a percentage point, bringing down the overnight rate to 4.5%. But what was not expected was some of the comments from the governor of the Bank of Canada, Tiff Macklem, today, really emphasizing balance, talking about the need to balance the reduction of the inflation rate with preserving economic growth. And to date, for the last couple of years, the bank has really been fixated on getting the inflation rate down into its target zone in this band between 1% and 3%. Ultimately, their target is 2%. But Macklem today really kind of warning about the risks of going too far, continuing to sustain a higher interest rate policy to bring down inflation, which could ultimately cripple the economy in future and lead to, of course, job losses and slowing economic growth. The last inflation numbers we got from Statistics Canada had the inflation rate at about 2.7% year over year in March. So that is kind of part of a trend. It's coming down. Macklem says he's confident about that. Here's what he had to say, though, about the future of potential rate cuts coming further down the road.
If inflation continues to ease broadly in line with our forecast, it is reasonable to expect further cuts in our policy rate. The timing will depend on how we see these opposing forces playing out. In other words, we will be taking our monetary policy decisions one at a time.
So this is a little bit complicated, this process, and it's not like you can, change the interest rates and expect the effect to be felt right away. It's a little bit kind of like driving a Zamboni. You got to start your turn long before you start crashing into the boards. So that's kind of what Macklem has to deal with on a regular basis. And of course, huge political implications here because the government, the Liberal government federally, has been dogged by high inflation and also the lack of affordable housing. So these two kind of things often work in opposition. By lowering the interest rates today, it should have an effect on the cost of living and on say the prices that people pay at the grocery stores or for durable goods, but it also could stir further heat up the housing market. We've seen a bit of a cooling, particularly in big cities like Toronto and the GTA, hearing a lot of stories about how condo prices are potentially coming down, people getting stuck who've prepaid for condos won't be able to afford them when they have to go in and ultimately pay for them once those condos are built and the deal closes. So that's one thing that the bank is watching very closely is on housing costs, on rents, and on mortgage rates as well. But FISA Mel will have 3 more opportunities for future rate cuts for the rest of the year. September, October, and then in December. And we'll see whether or not Macklem's approach has been the right one, sort of slowly lowering the rate as opposed to a larger cut that some analysts had hoped for.
Hey, what a great analogy to help us understand all of this. Glen McGregor in Ottawa, thank you so much.
You're welcome.